Good morning, it's Jeff Christian of CPM Group. It's about 9:50 on Tuesday, the 15th of February. Nice and cold here in New York. I hope you're in a warmer place. I wanted to talk today about investor and central bank gold holdings. Not so much actual investment demand trends, but the amount of gold that they hold. It's a critical part of the market that is perhaps misunderstood and underlooked. And also the role of gold, both in central bank and in private investor holdings. I won't go into that too much. It's a very elaborate thing. I've got a number of charts on private sector and central bank gold holdings and wealth, financial assets. Some of them are from last year's gold yearbook, primarily on the investment demand side. Because we're working on the 2022 yearbook now. It will come out on the 6th of April. We'll release it. It's an ebook, and the central bank chapter, the official transactions chapter, is completed, and so the central bank charts here are from the 2022 gold yearbook, which is yet to be released. The investment ones are a little bit older. But, we use this chart for decades. And I remember back around 2007, publishing this report in our yearbook and this chart in our yearbook and saying, private investors now own more gold than central banks. That was at a period of time when, private investors had been buying gold for 40 years, from 1960s, when they were more or less allowed legally in a series of things. You can see the investment demand gold holdings were around 334 million ounces was estimated to be held by investors from 1950 into 1966. The Swiss could always own gold. Then Europeans in the 60s were allowed to own gold in other European countries. The laws were relaxed in 1970, December 31st, 1974. Americans could own it. Japanese could own it, but there were export restrictions. And so Japanese tended to avoid gold because they were afraid that if they bought gold and imported it and bought it and held it, if they ever wanted to sell it, there could be a glutted Japanese market and a higher price outside of Japan. But in the late 1970s, the Japanese government relaxed the export restrictions and Japanese started buying. The Indians have always bought a lot of gold and probably own more gold than any other nation and group of people. And then the Chinese always were buying gold, but there was a series of legalizations in the 90s and then in 2001 within China, which relaxed the laws. So you saw this long period of time of investors being able and allowed and legally allowed to own gold, and they were buying gold and the price was rising consequently. At the same time, central banks, which had used gold for international trade settlements and capital flow settlements, were moving away from gold after 1967 and then 1971. And they were actually reducing some of the gold that they owned. So around 2006, 2007, you had that crossover. And today, investors, private sector groups, and sovereign wealth funds own about 1.4 billion, 1.42 billion ounces of gold. And central banks, which have since 2008 started buying gold again, are about 1.1 billion ounces of gold. So that's the stash of refined gold in coin and in bullion form above the market. This is the flow, net investor additions and reductions of inventories. Again, reductions, 3 years of small sales over the last 50 years. It's primarily investors are net buyers as a group in any given year. And since 2001, 2002, they have been consistently buying, well, from 2002 to 2013, they were consistently buying 20, 30, 40 million ounces of gold a year. They came down below that 2014 to 2019. And 2020, they shot back up. 2021, 2022 projection. This is projected through 2022. You can see it's been 38, 39 million ounces in 2020. The pandemic and the economic lockdown, it was about 43 million ounces. So investors have been buying a lot of gold. CPM Group issued a historic buy recommendation in November of 2000. We said the price was about $260 an ounce at the time, and we said we thought that the economic and political world would be much more hostile than it was even back in 1979, 1980, when gold went from $200 to $850 and then back down to $280. We said that we thought that the economic and political environment would be more hostile for decades to come, and that we would see an upward shift in the investment demand curve, with more investors in more parts of the world buying more gold at higher prices than ever before. We said that we thought that the gold price would go from $260 to well past $850. And we talked about what we called the gold renaissance, the revival of gold as a financial asset. And it's actually very interesting because the growth rate of the dollar value of gold holdings by investors, as well as ounces, has actually accelerated since that time. And we saw investors buy around 600 million ounces of gold from November of 2000 until through last year. About 599.3 is the actual number in our model, but it's about 600 million ounces. And again, that compares to that 344 million ounces that Anglo-American, Minorco, Charter Consolidated, the Anglo-American group, estimated in the early 1960s was the private holdings of gold globally. So we've seen in the last 21 years, investors buy much more gold than they owned or had accumulated in 6,000 years to 1966. And it's about 42% of private holdings have been acquired in the last 21 years. Which is interesting and important to pay attention to, because 42% of the gold that is owned by investors is owned by people, has only been owned for 20 years. So maybe a slightly different psychology there. We just don't know. We'll find out as time goes by. Now, I used this chart a few weeks ago. This is, a efficient frontier or investment horizon of a diversified portfolio: stocks, S&P 500, T-bills, and gold. And you add gold in 5% increments, and you see that from 0 to 20%, you're reducing the risk, the volatility of the value of your total portfolio, while you're actually increasing the net return. This is based on historical figures from 1968 through 2020. The past is not necessarily going to be repeated in the future, as financial advisors will tell you. But you can see that even then, after 20%, you continually increase the return of your portfolio in 5% increments, but the risk actually starts rising too. And that sweet spot seems to be 25, 30%, where you have a increase in your return, historical return, greater than the increase in risk. So 25 to 30% optimal holdings of gold in a portfolio over the last 50 years. Gold, if you look at it as a percentage, is global private sector financial wealth. Gold is the red bar. You probably can't see it. It's a little bitty line, very small at the top. It's hardly visible. Private debt, loans, loans down here, equities, government debt, paper assets, as people like to call them. These things have been growing at about a 9% per annum rate since 1980, when the data on those assets came. you could see from earlier charts, we have data on gold holdings, but the data on these other paper assets, we can really only date it back to 1980. And it's interesting because you've seen this 9% growth in paper asset holdings by private investors and institutional investors. And gold is very small. It's now 0.6%. Our estimates are that in 1968, when we were still on a gold dollar standard, maybe about 4.5% of private wealth globally was in gold. By 1980, we thought that it had fallen below 3%. These are our estimates, and those estimates are based on estimates of those other financial assets for which we don't have figures. We have a high confidence in the gold figures that we have in calculating this, but the figures for debt, loans, government debt, and equities are a little bit more sketchy. And of course, this excludes real estate. These are financial assets. But by 1990, it was down to about 0.5%. It fell as those paper assets were growing at 9%. It started to rise into 2011, 2012, came back down, and now it's rising again. But regardless, it has been less than 1% of global wealth, private wealth, throughout the period of time, really since 1980, since the early 1980s. Now, some people will look at that and say, well, when investors wake up and start buying a lot more gold and start holding a lot more of their wealth in gold, the price will skyrocket. And to some extent, they're true, but you have to watch out how you define your parameters. How much will investors buy? How many investors will buy? And what will skyrocketing be defined or quantified by? The reality is that most investors won't buy a whole lot of gold. There'll always be some that buy a lot of gold. There'll always be some people who are very wealthy and will buy a lot of gold. You know, we have clients who are billionaires and they have a lot of gold, but the gold is a relatively small portion of their total wealth. We have other clients who are billionaires who have a very large portion of their wealth in gold. So it'll spread over there. And most people are not billionaires. And in the United States and Europe and Japan, you don't have a lot of people sitting on a lot of cash to buy a lot of gold. So you used to hear this thing, well, if everybody in China bought an ounce of gold, the price would skyrocket. Well, everybody in China is not going to buy an ounce of gold because, you know, quite frankly, 400 million of them live day to day in abject poverty still. And you have a couple 100 million people unemployed there. So it's not going to happen. And that's a bad way to think about it. But a good way to think about it is, yes, investors, there is a gold renaissance. Investors are buying more gold. More investors are buying more gold for a longer period of time at higher prices in more parts of the world than ever before. And that's going to continue. But it's going to continue along the lines of what we've seen over the last 20, 40 years. It's not going to be a sudden thing. And it's not going to be a sudden thing because the parameters, the economic and political factors, as harsh as they are and as harsh as they're likely to get, are not going to be such to stimulate anything much more than that. CPM Group's long-term projections going out 10 years and beyond for gold is that investors will continue to buy more than 20 million ounces of gold a year. There'll be years when they might fall below that, but for the most part, we think that investors will continue to cycle into gold. There is a gold renaissance. People have rediscovered gold as a financial asset, as a store of wealth. There are still people who think that it's that it'll protect your purchasing power one-to-one forever. They don't quite understand the role of gold as a safe haven. But there'll always be people buying gold. And they'll probably be buying more gold as they have over the last 20 years for the next 20 years. So that's private sector gold. Here's central bank gold. Central banks used to buy a lot of gold, and that's because they used gold in international settlements. for both trade and capital flows. In the 1960s, you saw a raid on the US Treasury because the dollar gold price was fixed at $35 an ounce, and people around the world were trading dollars, as they still are. And they'd say, oh, I have dollars, you have gold, you want to give me your gold for $35 an ounce, here are my dollars. And you had this massive raid in 1967 into 1968. And in April of 1968, Lyndon Johnson was president, and he closed the private sector gold window because he had seen how much gold was being taken out of the Treasury in 1967 and in the first 3.5 months of 1968. And he said, we can't continue at this rate. So you then saw this period of demonetization. There were some sales in the 1970s. There were some purchases in the 1980s, mostly petrodollar sterilization. Oil prices had gone from $1 to $10 to $40 and then back to $10 or $20. There's a massive amount of money that was flowing into oil exporting countries, and people were converting their dollars into gold. And then you got into this long period of central banks being net sellers of gold. A lot of that was European, and it was in advance of 1999 when they went to the euro. I won't bore you with details. 2008, we started seeing net central bank purchases, and it's pretty much been that way ever since, mostly in the 5 to 7 to 10 to 11 million ounces per year, a few years where it spiked higher up to about 17 million ounces. But central banks, especially those that weren't participating in international trade back in the 50s and 60s, have been adding gold to their portfolio. What do they see? You see that period of decline where it was, 1.04 billion ounces of gold held by central banks, got down to less than 840 million ounces, and now it's back up, getting close to 1 billion ounces again. So central banks are buying gold. Bank of China best said it. They said, we, in 2015, I believe it was, they revised their gold management policies, and they publicly said, we see gold as a small but significant part of our monetary reserves. And that pretty much sums up the way most central banks see gold. They see gold as a significant part of their diversified monetary reserves, but they're not looking to have 50 or 60%, much less the 80 or 90 or 95% that the industrialized countries had back in the 1950s, 60s, and 70s. So you can see that it came down as a total group, and it's been bouncing around 10 to 15%, and it's probably going to continue to be that way. It's going to continue to be that way because central banks are living the same experience that private sector financial wealth is. You have seen, especially since 2001, this massive growth of foreign exchange reserves held by central banks. The gold, which is the gold part at the bottom, you can see the amount of the dollar value of gold that's held by central banks has actually risen sharply since they've freed the price. And even though they were selling gold and sold close to 20% of their gold, because the price was rising faster than they were selling gold, the value of their gold holdings actually rose because of the gold price being freed to float. But it couldn't compete with this vast growth in foreign exchange. And central banks around the world have said, we want foreign exchange because that's what we really need to defend our currency. And my last chart, the vast majority of those foreign exchange reserves are US dollars. And you'll hear people talk about how central banks around the world are dumping their dollars. And you can see from this chart that they're not. One of those things that guys say to try to convince you that the world is going to fall apart and that gold prices are going to skyrocket. Central banks want to diversify their portfolio. They want to diversify their reserves into other currencies. which just don't have the liquidity that the dollar has. There are any number of constraints that cause them to go more slowly than they perhaps would like to in diversifying their total monetary reserves away from the dollar into other currencies and gold. But from a perspective of a percentage of foreign exchange reserves held by central banks, you can see it's actually been relatively stable. There was this big increase in the late 90s as the European central banks that were going into the euro had to sell other European currencies, and they moved their assets from into gold. And you saw gold, a dollar into the US dollar rather, and you saw the US dollar as a percentage of foreign exchange reserves go from about 58% to about 68%. And then after the euro was introduced and time went by, the dollar diminished mostly by 2004, 2005. And really, but the last 15 years or so, we've pretty much been bouncing around 60% of foreign exchange reserves being in the US dollar. As I said, all of these charts came from either the 2021 Gold Yearbook, which is available on our website now for $160. You can download it as an ebook as soon as you buy it. And our 2022 Gold Yearbook will come out on April 6th. And some of these charts that I showed you today are in there. We'll have an open forum for our clients to ask questions next Tuesday. And then we are working on energy and metals seminar, online seminar for the middle of March, as well as our silver yearbook in May and our PGM yearbook in June. You can go to our website. You can find a number of free reads. There is a section that talks about all of the evidence against silver conspiracy theories. But there's a lot more about much more substantive and important things, including the outlook for gold and silver, supply and demand, platinum group metals, the role of energy metals in a energy transition. There's a lot of free reads in our market view section. There's information about our various research reports and consulting services. Take care, stay warm if you're in the Northern Hemisphere, and I'll be talking to you on Friday.